Hello, this video on the options market is on call options. In a separate video, I'm going to talk about put options. So like any other derivative, an option contract is an agreement between two parties. But unlike a derivative such as forward and futures contracts, an option contract is not a binding agreement. In fact, the party in possession of the option has the rights but not the obligation to either buy in the case of a call or sell in the case of a put option the underlying asset at a predetermined price, which is called exercise or strike price or a striking price within a predefined period of time. And if the option entitles you to exercise it at any time up until maturity, then it's called an American option. Otherwise, if you can only exercise the option at maturity, then it's called European option. Now, mark you, the names American and European have nothing to do with the continents. They simply refer to the style of the option with respect to when you can exercise them. So right here, I do provide some definition of terms. So right here, I introduce to you my favorite cartoon characters, Bugs Bunny and Elmer Fudd. Now, in this transaction, Bugs Bunny pays Elmer Fudd $6 to buy a call option. So this is the call option price, also called call option premium. Now, this call entitles Bugs Bunny, gives him the right, but not the obligation though, to buy a certain stock from Elmer Fudd for the strike price of $45. So this is the exercise price of the option. And Bugs Bunny has 3 months during which to exercise this option, otherwise it elapses. So now let's say that at maturity that the stock has gone up in price to $60. Wow, this option has expired in the money. Why? Well, because Bugs Bunny can approach Elmer Fudd and say, hey, I'd like to exercise my contract. Here's the $45 we agreed to. Now give it up. And Elmer Fudd, in his pensive mood, might be all sad and angry and say, and grab his shotgun as he often does, but he really can't do anything because he wrote the option and received $6 for it. So to the writer of the option, it's an obligation. The party with the rights is the holder of the option, the person in possession of the option. So he's going to have to deliver the stock and receive $45, even though right now in the open market the stock is selling for 60. So now for Bugs Bunny, we find that this is his profit function. Having paid 60 out front, which is a cash outflow, he now pays 45 to take delivery of the stock from Elmer Fudd, which he can turn around and sell it in the open market for $60 for a gain of 15. This gain is referred to as the intrinsic value of the option. Net of the 60 paid out front, his net profit is $9, which is the net loss that Elmer Fudd suffers, and that accounts for the sad face that he has right here because he received 6 out front. And right now, the $15 loss right here, which is the intrinsic value that Bugs Bunny enjoys, is up against him. So eventually, he loses $9 per share. So a couple of things here. One, it takes two parties speculating at cross purposes outside of the need to hedge to engage in an option contract such as this. And while Bugs Bunny is bullish, anticipating that prices will go up, Elmer Fudd is bearish, anticipating that prices will stay the same or probably go down. Because then if it goes down, he gets to pocket the premium that he received, which is what you find here in this second instance, because here stock prices have gone down and Bugs Bunny will not exercise, because why would he want to exercise to pay 45 for a stock costing only 40 in the open market? So this option has expired out of the money and he will let the option expire unexercised, and as a result the mathematical aspect here would not be affected. The option is out of the money. He will not exercise it because remember, the holder of an option has the rights but not the obligation. So the intrinsic value here would be 0, and therefore he loses no more than the $6 he paid in premium to get into this, which of course is what would cause Elmer Fudd to be delighted, because then he gets to keep the premium since Bugs Bunny would not exercise. And by now, you probably can see the relationship between an option contract and insurance. It's like you buying an auto insurance, and the insurance company, you agree to a deductible of 45 bucks and you paid an insurance premium of 6. And so if you have an accident, if I go back here, and you're only going to be responsible for paying the $45 of deductible right here, and the insurance company gets to pay the difference, as in this case 15. And the insurance company hopes you don't file a claim, meaning that you're a safe driver, no accidents, in which case the insurance company gets to happily keep the premium that you paid. So this is the nature of this transaction. Now let's see exactly how this works out in the options market. And for that, I'm going to go to the web page of the Chicago Board Options Exchange, or CBOE as we call it, and look at options traded on ExxonMobil, the powerful oil company. And right now on September 9th, Exxon stock is selling for $38.43. And right here we can see price quotes for call options on the left and put options on the right. So we're going to focus on the call options for now. And as you can see right here, we do have several options with different strike prices for the same maturity dates of October 2nd trading on this stock. All right, and there are others down here. But consider this option with an exercise price of 37, for example. We see here that since the stock price is 38.43, the intrinsic value of this first option is 1.43. Intrinsic value is stock price minus exercise price. The price, though, of the call option is 1.94. So you can see that even though intrinsic value is 1.43, investors are paying 51 cents over and above that intrinsic value. Why? Well, that difference of 51 cents, which is 1.94 minus 1.43, is called time value. They are paying 51 cents per share for the advantage of time, because they still have up until October 2nd. All right, today is September 9th. They still have up to October 7th before to expect that this stock is going to turn around profitably for them. For it to turn around, the price has to go up by 51 cents more. If it goes up, in other words, it's going to go up to $38.94 for there to be a break-even, if you pay 1.94. Secondly, observe that the value of an option is a positive function of time, because as you can see, as we move from October 2nd to 9th to 16th to 23rd, etc., observe that for any of these options with the same exercise price, let's look at this one with an exercise price of 39. The price for October 2nd is 1.27. Move down to maturity of October 9th. The price for the same option with an exercise price of 39 is now 1.42. That's what investors are paying right now. And if we go down further to expiration of October 23rd, it's even higher, 1.65. So obviously, as you can see, the longer the expiration time of an option, the higher the value of an option, the price of an option too. And what that means, that simply is suggesting that for options with longer expiration, you do have more time to play and hope for a turnaround that will be in your favor. The second is that the value of an option is a negative function of exercise price. So let's look at this, for example. As exercise price goes up from 35 to 37.5, 40, 42, observe that prices go down. The reason being that the intrinsic value of the option is less. Nevertheless, observe, importantly actually I should say, observe that, yeah, while it is true, going back here, that you can pay more to purchase an option, you can pay more than the intrinsic value to purchase an option, as in this example, it's not going to be the case that the price of an option would be below its intrinsic value. Again, remember, intrinsic value of this option is 38.43 minus 37, which is 1.43. You can have a price of less than 1.43. If you do, that's actually an arbitrage opportunity. For example, look at this one right here. So suppose the stock is selling for 38. An option written on the stock has an exercise price of 35. That means on this option, call option, you have an intrinsic value of 3. S stock price minus exercise price. Suppose the call price is below this $3, say 2.75. Now that's an arbitrage opportunity. What you should do is to go ahead and pay 2.75 and buy the call. It's a cash outflow. After purchasing the call, exercise it immediately to realize this intrinsic value of 3 right here. So your net profit right here is 25 cents per share. Now, one option contract calls for the delivery of 100 shares. So if you purchase several contracts, we're talking about, again, an arbitrage profit that may be in the hundreds of thousands of dollars. So so finally, while an option that still has time to expire can sell at above the intrinsic value, it is unlikely to sell for below its intrinsic value. At expiration, though, when there is no longer a time value left, you can expect an option to be either worthless if it is out of the money, or to sell at exactly its intrinsic value, since there would be no benefits to pay anything more to purchase an option that expires in the next instant of time. Hope you enjoyed it. That's it.